This is the macro show. This is pregame, okay? We're trying to play the game that's in front of us today. You know, leadership matters at Hedgeye. So again, being transparent, accountable, and trustworthy people. This is a game about playing and weighing probabilities. It's not about picking stocks. It's about picking the right portfolio.
Tax refunds, they've gone from a tailwind to a headwind. And you can see on this next slide here, I would point you towards the right-hand side of that, which is the average tax refund for 2023 versus 2022, down about 10%. Not a good read. People spend their tax refunds immediately, and they spend them on the kind of goods of the companies I cover. So just a very, very bad read headed into April and May, which is when I think we're going to see a trough in demand. If you want to take a look at this next slide, you can see its impact on PCE. It's not huge, but it's negative. So starting in March, negative slightly, and then negative down 1%, then negative 1.6. That's actually a pretty big number. Consumption is 72% of GDP. And we definitely have got to keep an eye on this one. I know Keith talks about that a lot, as he should, because it's such an important part of the economy. Next one is SNAP cuts, or food stamps. We saw a big hit. You could see, Taylor, I pilfered this out of your deck, out of your macro deck.
It looks familiar.
You probably did the work on this one, but we saw 30 million households take a massive hit to their SNAP payments at the start of March, and that was across 35 states. If you take a look at this next slide here, you can see what that did. We were, from January through the end of February, we were at sales rates. This is your Red Book sales, which is a pretty accurate read of what's going on out there, of about, call it 5% or so, in between 4 and 5, and you just saw an immediate drop down to +3. So you had about a 200 basis point hit there because of this SNAP cut, and then lo and behold, you see this down from 3.7. I have people saying, "Oh, Brian, look, the sales are trending up again. They're going from 2.6 to 3 to 3.7, and boom, down to 1.5. That's your tax refunds, which is and your rising personal savings rate. So this is just a very bad read. The companies out there have guidance, which is very hindsight looking, and that's baked into the consensus estimates. Guidance is going to come down. It's going to come down big over the May to June timeframe when retailers put out earnings, and estimates are going to follow. Maybe that's when I turn bearish if I can point to a positive rate of change. Maybe that's when we're getting out of quad 4 and into a better spot. But I definitely don't want to be early. Like, I would rather buy these stocks 5-10% higher and de-risk losing money. I hate losing money. So I would rather buy them higher and get that next 80% run in the stocks than risk, destroying capital. Here's a bullish slide. If you take a look at personal income growth, it's been growing in recent months, which is good. It's gone from, about a year ago, we were looking at like 1, 2, 3% growth, and now we're at 6%, which is great. Problem is, when you take a look at the following slide and you look at inflation, which is just outpacing income. So food at home, shelter, food away from home, are all just going up, and they're going up at a greater rate than inflation, which basically is telling me that the consumer, although we're seeing a 6% growth in nominal wage increases or income increases, is actually seeing a pay cut relative to what they have to spend on essentials. Again, that leaves less room for discretionary, which is where I live.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.